Bloomberg News reports there are no immediate plans for an acquisition, but Sumitomo Mitsui owns 15% already, and Bloomberg Intelligence financial analyst Neil Sipes says it could be a credible end state, these two banks together. So, Neil, talk us through the relationship the two have now and, if a takeover would make sense.
Yeah, so this relationship has sort of been building over time, over the past handful of years now, as Japanese banks look to sort of enter the U.S. market, particularly in a capital markets fashion, Jefferies being the story here for Sumitomo. So this isn't necessarily a new sort of development of them getting involved with Jefferies. We've pushed up to 15% stake now, potential to go to 20%. And, you could argue in a longer term period, it's always possible that this could have happened. But right now we're looking at this more as sort of an opportunistic potential and story rather than an imminent action. And really, when you look at Jefferies, we've sort of been caught up in a couple of the credit concerns in the clouds. And those headlines around it that have weighed pretty dramatically on the stock. So the stock's sort of in the penalty box right now for some of these sort of non-core items, we'll call them, because when you think about it, most of it has emanated from the smaller asset management business, which is less than 5% of revenue for Jefferies. When you think of Jefferies, you're thinking about the investment banking, the trading side of the business, which is over 90% of revenue today.
Although I'm thinking about, when I think about Jefferies, I think about a stock that's lost almost half its value in half a year.
Yeah.
I mean, that is an incredible drop. Yeah. Regardless of what's causing that, it's just worth far less. And if something is worth that much less, more people who are potential buyers may actually act on that.
Right. And someone who has a strategic stake may see the true value in the franchise there, maybe not what the market is currently assigning it based on, again, some of the, we'll call them financially manageable credit concerns out there around Jefferies with the First Brands and MFS. Those are pretty small and manageable in the whole context of the earnings power and the capital that we see at Jefferies. When you have a strategic partner like Sumitomo, this sort of opportunity can arise. Obviously, we're working through these headlines like you are, so we'll have to see what actually develops from it. But possible, but again, looks more opportunistic, just based on where things are trading today than sort of the long-term strategic goal.
Another little bit of deal news in the financial world is that Janus Henderson, which already agreed to be bought by Trian and General Catalyst, got a bid from Victory Capital. They come in, I think they're somewhere near $57 a share. They don't want to be bought by them. Janus Henderson gets an increased bid from Trian. I mean, why is Victory still trying here? What is the back and forth? Because it seems not great to try to buy a fund where the employees don't want to work for you. Yeah,
so and when you look at someone like Victory, who's been doing a handful of acquisitions in the space over time now, they're really trying to build scale. When you think about scale M&A in this space, that comes with cost cuts, right? And so I think that's where you see some of these headlines stemming from is, the Victory proposal, which is, less attractive, at least in the employees' eyes. You see about 90% of employees or managing 90% of the assets, at least against the Victory transaction. 33% of managers or managers running 33% of the revenue, I should say, are opposed to the transaction. And I think that stems from the idea that there's uncertainty as to where those cuts are going to come. And when you think about a non-financial transaction like the one that Trian's proposing, perhaps more strategic with less cuts on the other side, you got to make sure that the asset that you're buying is still going to be there once that transaction's complete. And I think that's where the questions stem around the Victory proposal.
Right. And to be clear, the people are the asset. I mean, right? It's nothing more than the actual fund managers.
Good way to cut costs is just let all of them leave.
I mean, you're not buying them for IP.
Right. Well, you could be, but in some sense, that's actually the managers who are the IP, right? So that stems the argument as well. And so when you think about that, you look at prior transactions in the asset management space, a lot of financial type transactions, we've seen 20 to 30% of the cost base taken out. What you've also seen is subsequent outflows from some of the flagship funds. And frankly, you end up with a smaller franchise and perhaps less powerful franchise moving forward. So things to weigh there as you sort of had a pretty interesting bidding war developing.
Neil, thank you very much for joining us. That's Neil Sipes of Bloomberg Intelligence.